Of all the many disruptive technologies out there, financial services tech is definitely one of the most promising long-term growth investment opportunities.
You may know that we've been very bullish about investing in the fintech industry over the last year. We spent 2021 covering the public market debut of SoFi, the one-stop shop online bank. So let's take some time to cover one of its competitors, another rising fintech star, Upstart.
We're going to explore what Upstart is all about, including how it makes money through its unique lending solution, its valuation history and projections, what they offer their customers, and everything else you need to know to help you decide whether it's a good investment for your growth portfolio. I'm Danielle, and you are watching bullacademy.org on YouTube. If you enjoy this video and want to see more like it, don't forget to hit the like button, subscribe to the channel, and hit the notification bell below. If you have thoughts on this topic, we would love to hear from you in the comments below. Finally, these videos are brought to you by our patrons at patreon.bullacademy.org. We do this show together, and their financial support keeps this channel going. If you'd like to join our live chat community on Discord, you can learn more at patreon.bullacademy.org. Now, let's explore the story and future of Upstart. Founded in 2012 by current CEO Dave Gerard with partners Anna Councilman and Paul Gu, Upstart was the first to leverage both modern tech and data science to automate much of the lending process.
That process, which is used by lenders to minimize the risk associated with any given borrower, includes document review, fraud analysis, rate request, servicing, and collections.
In 2014, thanks to its robust and quick risk assessment algorithms, Upstart was also the first to launch next-day funding of loans, which meant borrowers could start using their money significantly earlier than ever before. Despite the borrowers interacting directly with Upstart, the company itself isn't a lender. Instead, the platform equips primarily small regional banks with artificial intelligence software packaged in an API or application programming interface that's almost instantly assesses a potential borrower's creditworthiness via complex algorithms and robust prediction models. Having just 10 banking partners at the time of its IPO in 2020, Upstart has grown its client base to 30 lenders just over a year later.
This impressive growth still leaves a lot of room for the lending platform and its stock to grow as they acquire more bank partners from the thousands available in the United States. Bank partners using Upstart's tech can automate personal loans of $1,000 to $50,000 at 3 to 5 year terms. Ultimately, the company aims to expand borrowers' access to credit, factoring in upwards of 1,600 additional variables with more traditional metrics like income to determine creditworthiness.
With all of this, Upstart is upending the outdated FICO credit score systems of points, which originated in the 1980s. In fact, 4 of Upstart's banking partners no longer use the FICO scores for lending.
As a Seeking Alpha article mentioned, nearly 70% of these loans are instantly approved.
As with any new approach to financial transactions, regulators have closely monitored Upstart from the start to ensure its technology wasn't leading to fraud nor abuse. Interestingly, in 2017, the Consumer Financial Protection Bureau announced a no-action letter to Upstart, where they referred to their use of additional metrics as producing alternative data. As detailed on the CFPB website, the letter signified that the Bureau did not intend to implement or enforce supervisory actions against the company for its untraditional evaluation practices. However, Upstart was required to regularly report lending and compliance information to the CFPB to aid the Bureau's understanding of the real-world impact of alternative data on loan decision-making.
In a 2019 hearing in Washington, D.C., before the House Task Force on Financial Technology, Gerard, Upstart CEO, validated these same concerns about fairness in algorithmic lending and alternative data as well-founded, asserting fairness as a founding principle of the company.
Upstart has been optimizing their data models that banks use to estimate default risk for both personal and more recently auto loans for nearly a decade now. They're made available to banks and other financial institutions for a fee. Using a largely fee-based business model, Upstart gets most of its revenue from referral fees for each loan, platform fees, and loan servicing fees as customers pay down their debts. According to Integrator, an author at Seeking Alpha, the problem that Upstart is solving is a large and significant one: efficient access to credit by consumers. 80% of borrowers have never defaulted on a loan, yet only 48% of borrowers have access to prime credit. Upstart seeks to tap into this prospective borrower pool. In the same article, it was mentioned that the market for unsecured personal loans is close to $90 billion. This presents a huge opportunity for Upstart to earn outsized and sustainable profits. In 2020, Upstart has issued about $8 billion in loans, which puts them at a market share of slightly less than 10%. The company is already well profitable, with net profit margins of 13% in its latest quarterly earnings report, while still maintaining extremely high revenue growth rates of triple digits. Upstart went public with a per-share price of $20 in late 2020, and since then, its stock price has increased by nearly 7 times. It has a current market cap of about $11 billion to start 2022, after seeing its stock price surge 220% from $125 in June of 2021 to a 52-week high of $401 in September, before falling 67% back to its current position of $132 per share. At its highs, early investors saw gains of more than 20 times, in less than a year of being a publicly traded company. It's now clear that was an unsustainable rate of stock price appreciation in such a short period of time. Still, 7 times in just over a year is surely more than enough for the bulls. The question that remains for Upstart's most eager investors is how much higher can it go from here, and how soon?
I'm Lincoln, and you are watching bullacademy.org. If you enjoyed this video, please do remember to like it below, subscribe to the channel, hit the notification bell, and comment your thoughts below. All of your engagement means a lot to the channel and helps us grow because YouTube's algorithm won't recommend our videos unless you engage with it. Thank you, and now let's hop in.
Much of the bullish excitement around Upstart's growth story has to do with its growing profitability. Beating analyst expectations, the company has seen 4 straight quarters of positive earnings per share, starting at just above $0 to sitting consistently around 60 cents per share. Their GAAP profit margins hit an impressive 19% in the second quarter of 2021, up more than 160% year over year. Upstart's revenue estimate for the fiscal period ending December of 2021 is $806 million, with what would be an astoundingly high year-over-year growth rate of 246%. From there, consensus estimates expect the company's revenue to grow by approximately 40%, another $800 million in 2022. On top of all of this, Upstart is seeing its cash on hand consistently increasing each quarter, doubling between the second quarter and third quarter of 2021 to $1 billion. All of these metrics point to a strong business with a solid foundation for continued, rapid, yet profitable growth. To make all of this possible, Upstart is not only taking advantage of the large personal loan market, it's begun its expansion plans. Recently, the stellar management team has begun to target both the auto and mortgage lending market. With its acquisition of Prodigy in September 2020, the company issued its first auto loan as an exciting step towards the $672 billion auto lending market. But no business is without risk. Indeed, Upstart does face a number of risks. For one, the company has a very high customer concentration. In response to this concern, Upstart has tried to diversify its revenue base by bolstering its network of lenders with more partners in the past year. Still, the company's very dependence on small banking partners for loan origination is another risk in and of itself. On the same note of overdependence on partners, having Credit Karma as the lead generator of nearly 44% of its referrals might leave some investors unsettled. That being said, Upstart continues to work on minimizing its dependence on any one bank partner as it grows its network. Unless investors wanted to apply for a bank charter, working with partner banks is just a cost of doing business that investors must accept. As far as their dependence on Credit Karma is concerned, Upstart's team is actively moving towards more direct acquisition channels. When it comes to the performance of the stock, as I noted earlier, it's still up 7 times, only a year after its public debut. With expected 2022 revenues of $1.25 billion, the current forward price to share multiple of Upstart stock is about 9 times, which is reasonable for its growth rate and sector. Even a multiple of 12 to 15 times would be within reason, given that of its competitors such as SoFi and Lending Club. However, the market currently seems to believe that Upstart is overvalued as its stock continues to fall, now down 58% over the last 3 months. Despite the fact that 60% of Upstart's analysts believe the stock is a buy and that the average price target is $258, representing an upside of more than 90%, the market appears to agree with the 10% of analysts who say sell. As the selling pressure continues, the stock price is already well below the lowest analyst price target of $160. The risk to investors, at least in the near term, is that the bearish sentiment could continue for the foreseeable future, causing the stock price to stagnate or fall lower towards its 2021 low range of $40 to $100 per share. Major competitors include Float, SoFi, Lending Home, and Earnest. Let's make a quick comparison with SoFi. Upstart is clearly targeting borrowers with bad to fair credit, while SoFi targets borrowers with good credit and high salaries as part of its strategy of catering to customers who it considers high earners not well served. Upstart's minimum credit score requirement is 580, as opposed to SoFi's 660. However, Upstart's competitive advantage is in its pioneering use of AI in the lending process itself. Although competitors like SoFi are catching up, as we continue to observe trends in the modern market, we see a noteworthy increase in the use of data science and machine learning in these disruptive technologies. Upstart deserves much of the credit for this trend. Nonetheless, one disadvantage that Upstart might soon have to a competitor like SoFi is that it is not a bank that can originate its own loans. SoFi, unlike Upstart, is seeking a national bank charter, which would allow it to originate its own loans, allowing it to keep all of its profits. With that said, this could very well be a disadvantage Upstart and its investors are perfectly willing to concede and focus on being the best at providing useful data to its banking partners on its platform. With a novel approach to informing lending decisions, Upstart has found a promising business model that is proving profitable for its partners and its bullish shareholders. While the bears can point to an arguably inflated share price that may or may not be justified, Upstart has proven its approach to doing business by providing immense value to its lending partners and their customers in the marketplace. Whether the share price will turn back towards its previous highs soon enough to reward the bullish traders even more than it already has is a question that remains to be discussed. However, it's likely that those investors who focus on the long-term potential of the fundamental growth story that Upstart is writing rather than its short-term stock price fluctuations will benefit most from the appreciation of the value of this asset. You have been watching bullacademy.org on YouTube, where we teach long-term investing by breaking down concepts and telling the stories of companies to help you build long-lasting, sustainable wealth. We hope you enjoyed this video, and if you did and want to see more like it, please remember to like the video below, subscribe to the channel, hit the notification button, and comment your thoughts on this topic. I would love to hear from you, and I always do my best to respond to every comment. As always, this video has been brought to you by our patrons at patreon.bullacademy.org, who support this channel financially to help us keep going and help me brainstorm new video ideas to share with all of you. We do all of this in our private Discord chat, where we discuss the stock market in real time every day by sharing news, rumors, and new investment ideas so that we can all do our own research and then come back together and collaborate. So, if you're interested in all of that, I hope you'll join us at patreon.bullacademy.org. I'm Danielle with bullacademy.org. Thank you again and have a great day.